Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Econ Show, we have a lot to cover, as it always seems to happen in front of a short week. But we're going to hit on what happened with Biden in terms of the new infrastructure plan. What does it mean for stimulus within the U.S. and abroad when we think about the knock-on effects going from there, which is why we just want to look at what does global stimulus look like. Then we're going to shift to those inflation pressures, because we keep talking about inflation and how it's coming on shore. And this is why we're looking at where is it originating, and then when is it going to hit the consumer, as we already think it has hit the consumer, and it's only going to ratchet up higher. And then the U.S. consumer continues to see some mixed data points, especially based on what level that you're at in terms of just your ability to work or just try to own assets. So we're going to talk about different impacts to the U.S. consumer. And then we're going to look at European data, which has gotten better, but what does it mean as COVID cases continue to rise and we see an extension of lockdowns, shifting into our favorite topic about Asia, looking at Indian data points, Chinese data points, and some of the other key sides of Vietnam and South Korea, because some of those data, some of the data has gotten a little bit better, some of it a bit worse, and we'll go through what are going to be some of those driving points on the outset. So when we turn to the U.S. in general, and we want to look at, okay, well, what is the infrastructure plan? Okay, well, let's get a semblance of an idea. It's still in the works. It's not happened yet, but this is what is being talked about when we look at the spending and revenue component of Biden's infrastructure plan. It has already been pared back. I think there was a lot of sticker shock where even Democrats were like, no, this is too much. We need to let some of this actually work through the system. But this is a bit of the pared back version, where transportation, infrastructure, and electric vehicles will get $621 billion, green housing, schools, power, and water, $561 billion, manufacturing subsidies, $480 billion, elder and disability care, $400 billion, broadband and job training, internet and job training, $200 billion. Now, on the corporate side, corporate taxes are supposed to increase to 28%. That's going to bring in $695 billion. Global minimum tax increase to $495 billion. Repeal tax loophole for intangible income, $217 billion. And fossil fuel tax breaks and anti-inversion measures, $54 billion. So those are going to be some of those reversal sides. And up here, France starts 4-week nationwide lockdown on Saturday. So that's what we're going to see coming out of France, which is actually going to be important to talk about in the next few slides. So when we're looking at this is the 10-year plan on when this money is going to be pushed out. The biggest one is going to be transportation, infrastructure, and electrical vehicles. The view is to increase the amount of charging stations while also increasing the amount of infrastructure, again, doubling down on the green side, while really not, I think, addressing one of the bigger issues, which is our highway system, because it's only supposed to look at about 26% of it, which if anybody's in the Northeast, you might as well just rip it up and start again. So again, these are some of the things that are being done. And the idea is that this is going to be a longer term move where you'll get the value of money starting to increase when you look at the multiplier effect, because it'll make trade easier. The idea from their perspective, increase the adoption of EVs, though that then gets us into battery and technology, but we can do that another time. Here we're just trying to look at what does the stimulus mean, but what does the stimulus mean? Because we're not getting the tax receipts that we need, but a lot of this investment has to happen up front as the taxes are collected over time. So that then leads us short tax receipts, which means we're going to have to borrow more. And as we continue to see countries looking to borrow more, it's becoming a bigger problem. So when we look at, this is just looking at India and breaking it down versus other regions, and we're going to show why we're talking about India here. But India's February inflation was above the 4% midpoint. It's up to about 5.3%, which is again becoming a bit concerning as we continue to see Indonesia was in line, Philippines was elevated, Thailand is on the up, and Vietnam is coming into right within the sweet spot. And we're going to talk about Vietnam in segment 5, because Vietnam is part of where a lot of this data is getting better, and we're seeing a lot of growth out of Vietnam, which not even in the long term, over the next few quarters, we think that's going to come at an impact to Chinese demand, as we've already seen a lot of these supply chain shift. Vietnam has been a focal point for a lot of these shifts, especially from Apple and some of the other tech guys, which is going to make Vietnam, I think, more important. The problem is going to be India, as we continue to see inflation pressuring to the upside. Food prices are limit up, as we just got the data coming from the planting acres. Russia had some deferrals, and with their wheat, it's now going to be in grains in general, is going to be an April event, which is just pushing a lot of this inflation higher within Asia, but they still need stimulus. This is why monetary policy is becoming a bigger focal point, with Russia increasing rates at the central bank, Mexico turning hawkish, Brazil raising rates, and this level of comfort is getting pressed, and with just what is happening at the outset is just going to limit the amount of new stimulus that can really come to market, because the monetary policy, they'd rather let the fiscal work a bit more, so they're going to be more aggressive on monetary, try to pull down some liquidity while trying to let some of this fiscal move through the system. Now, what is that doing? So when you look at what the U.S. is doing, we're increasing the amount that we're looking to borrow, but we also have a little bit of an increase of foreign buying. And here you can see that the foreign buying has increased. This isn't, clearly they marked the U.S. election, but this isn't an electionary thing. This is just inflation has become a problem, and we need to address inflation. So we're going to purchase more treasury bills, because that's going to bring in more dollars. So if you think about how do you try to garner or slow down the inflation side, you're going to pick up the amount of dollars you have in your reserve. You're going to pick up the amount of treasuries, which has been that steady increase. The problem is we're just issuing a ton of new paper, which is offsetting some of these increases, just because we have such a high stimulus that is coming through that is just capping some of this total flow through. Then when we look at, just how much, now just to be clear, this does not include the infrastructure bill. So right now, the U.S., and this, just look at what we did in 2008. So this is 2008 to 2010. And this is now the fiscal stimulus as for new stimulus. So when you look at the percentage of GDP, we're putting out, and again, not including infrastructure, 25% of GDP in stimulus. And this is why we continue to see these big overhangs in general when we start looking at what is happening in general. How is this going to, where is this money going to come from? Canada had a lot come out already. Japan is doing another leg. And then this is why it's important when we start looking at Europe, because Europe is going to need another leg higher, with Italy being a one that we're going to talk about. Now, this is why when we look further down the scale, Russia has had to pull back some of their stimulus because they haven't been able to issue bonds. They had to pull one of their offerings, which so far they'll probably come back to market now that they've seen some of the yield curve normalize. But China is the one that is extending some stimulus that's already available. So they're just renewing it, but they're not issuing new stimulus because they're trying to take some of the liquidity out. So that's where we're continuing to get the shift, where the US and Europe are doing more. And we're seeing Asia and some of the European nations that are just slowing, Eastern European nations, where inflation and other issues that are expanding into Latin America are going to limit the amount of growth available. So then when we look at just the direct government aid and central bank purchases of corporate bonds, you can see that just the direct aid for European leverage finance companies, ECB net purchases, and the Fed, the ECB continues to ratchet up. And we'll talk about this more in segment 4 when we look at what has the ECB done, how are they doing it, and how can they maintain this, because this should have been against the ECB mandates. It has now been included in the mandates. So essentially any issue or limitations has been removed, which is going to be a problem going forward. Now, when we start looking at inflation above 3%, and what is that? Why could that be a problem? So this is looking at the CAPE impact. So the cyclically adjusted price to earnings ratio. So it's calculating essentially the company's stock price by the average of the company's earnings for the last 10 years adjusted for inflation. So the question is always going to be, well, what was inflation? And this is starting to show some of the pain that is coming in to some of these corporations. And at the same time, it doesn't reflect just how tough things are going to be when we start looking at prices paid versus prices received, and how margin compression is going to come through unless you're going to be able to see some of these guys increase just what are they charging the consumer. And there's going to be a point in which the market's going to push back on that. So the CAPE ratio allows the assessment of companies' profitability over different periods of an economic cycle. The ratio also considers economic fluctuations, including the economy's expansion and recession, essentially provides a broader view of a company's profitability by smoothing out the cyclical effects of the economy. So you can see just what it means when we start getting above that 3% and you start going towards that 10% level. And this is why when we look at deflation versus inflationary aspects, and as inflation increases, you're going to have to see this pricing get pushed down, or it's going to impact corporate revenue. And this is where we want to look at some of the interesting capacity that's going to come into or evaluating different companies. So then when we just get back to, okay, well, why are we talking so much about Biden and the stimulus? Because this is going to reverberate through the system. What do we have to do when we build EVs, when we build all this stuff? We need lithium, copper. We're going to build new charging stations. That's more copper. We're going to need cement. We're going to need blacktop. We're going to need rebar. So we have to purchase all these things. So this is going to be a benefit for the rest of the world in terms of just having a captive buyer. But this is when we look at the spending and revenue as a percentage of GDP and what's projected. So the spending remains at these highs that we haven't seen since World War II. Spending under current law, which is the highest that we haven't seen since, again, World War II, because the rest is projected. And then the tax increases. So you can see that we're still going to have to paper the town because we're going to have a big shortfall in terms of these tax receipts. And then looked at it a little bit differently, when you start looking at what are the shifts happening around the world in general, because, okay, well, we're trying to maintain low rates, so we're maintaining low rates, but we're going to have to increase the amount of borrowing, which is driving up rates, while central banks try to cap rates. And what has that done? That has pushed up asset prices. So when you look at the U.S., the Case-Shiller National Home Price Index has exploded to the upside, but yet the owner's equivalent rent of residency remains flattish in general, which is why it hasn't accelerated with this price increase, which is why we think that this is going to continue to shift higher. But this will then put pressure on the consumer because the consumer's biggest spend is rent. So if you're not spending as much and if you're not able to invest as much, then how do you then push through tax increases? So if you can't get your tax increases from cap gains or from just investment in general, and you're relying on the government, that means that you're going to have to increase taxes. And where are you going to increase taxes? You're going to increase it where you can, and property taxes is going to be a big one, which again is going to cap some of this home price index, but is going to increase rent as the landlords try to push down some of these increases. So then when we look at it a different way, well, what about around the world? Well, let's look at the around the world. You can see Canada and the UK, France, all of these countries that have maintained these low to negative rates continues to just shift just housing prices to all-time highs around the world. And at some point, at what point that is, I do not know. You need to see some of this turn down or this price discovery, and it really isn't going to start happening until you get rates pushing up. Because as rates go up, specifically looking at the 10-year to the 30-year, that's going to drive up mortgage rates, and then that will start to see some of this pricing slow down. And at the same time, when taxes start to increase, you're going to see some of those pressures be pushed down as well. So then when we look at the inflation-adjusted housing prices across the OECD, you can see that, again, it's just continuing to push up. Going back to 2007, you can see that we're now back to those highs. We're in the 37 wealthy countries that make up the OECD. Home prices rose almost 5% from a year earlier in the third quarter, the fastest growth in nearly 20 years. So if you owned a home, again, this comes to that K-shape of if you owned a home in these 37 countries, you crushed it. You have assets, you have growth, you have household income. But if you don't own it, then what was your benefit? You essentially have savings that are earning you nothing, which is again putting some of this and capping some of this growth. Which is why when we start then looking at, well, how are people making it up? They're borrowing, they're getting margin debt, and they're trying to invest it to try to generate some of this growth. And that's where here you can see that when we look at margin debt, just in terms of FINRA, so FINRA margin debt has us at all-time highs, with margin debt up 15.1 billion month over month in Feb to 817.7 billion. So we're getting to a record, which is up 334.4 billion from the March of 20 low. So clearly, by the time this ends, we will be at about $1 trillion in margin debt. And obviously, when we start looking at Bill Wong and what happened with the family office, and now it's apparently there's more than that. What does this look like when we start looking at total return swaps, interest rate swaps, forwards, futures, forwards, and the different types of FX contracts? All of a sudden, this starts to get elevated. Not to say that the smaller individual can do that, but again, we're moving up in a different way. And then looking at it a little differently, the growth of U.S. margin debt in the last 12 months so we're looking at U.S. equity margin debt versus the S&P 500 market cap, which is a little bit more pared back, but you can still see that we're moving in one direction. And clearly, as it got very high, you can see that we reached peaks in those different time periods. And the hedge funds are really leading the charge. When you look at the top 10 funds by gross asset value, clearly there remains a problem, as we talked about in March of 2020. A lot of these funds that were levered long multiple times over are now were insolvent. That was when Jay Powell came in and just printed the world, but since then they've tried to take down some of that leverage, but they still remain very elevated even versus the remaining funds in the world. So then when we look at, what is going to happen in the U.S., let's do this quick summary of what do we expect. Well, when we start looking at U.S. companies throughout the period, leisure and hospitality continue to be the leaders. And as we talk about in the EIA show segment 2, the open table data continues to point to leisure and hospitality is going to print the way, which is why we think that the jobs numbers will surprise to the upside. Even though ADP was about 515, the expectation was 530, slightly below estimates. We think it's going to be the opposite, and a lot of individuals are expecting about 697,000. We think it could be very well be greater than that and closer to 750, just based on those leisure and hospitality numbers. And this is just looking at Oxford. So this is looking at their estimates. They're assuming that we're going to get about 700,000 added in March. It's going to be a matter of, well, what does that look like? But clearly there's stimulus behind it. But is stimulus also keeping people at home because you're going to make more collecting pandemic unemployment, extended benefits versus going into a construction or becoming a waiter, waitress, a bus boy in general? So again, these are things that we have to watch, and that could mitigate some of that growth. But we don't think it does. We think that they will still get that big surge in March, as we've been talking about for the last few weeks. This is just looking at what happened in the ADP numbers. So payroll is weaker than expected, but strong. So 517 was the expectation, came in at 517. The expectation was for 550. The previous month was revised up by about 60,000. Large companies, mid-sized companies, small companies all saw positive growth, with services at 476,000, goods at 80,000, and leisure and hospitality making up the lion's share of that of 169,000. So then when we look at, okay, well, what is that driving? We talked about stimulus, we've talked about inflation, we've talked about some growth in the U.S. Well, we continue to see the 10-year push higher. And as the 10-year continues to push higher, you can see the rate of change is the fastest since 1994. This is something where we think the 10-year is going to continue to push up. It'll likely get to 2% very quickly, and then from there on its way to 2.2% based on what we expect to see in the market in general. So what is going to drive that? And this is where we start looking at PMI and the global PMI data points, because the global consumer price index continues to push higher. The global PMI input cost continues to push higher, but consumer price index still remains fairly low. And this is going to have to close. We're going to have to see this collapse. Otherwise, companies are just going to be losing money, or they're just going to see their margin whittle away to nothing unless we see that consumer price index. And that's going to be the pass through. That's where, when we look at input costs over the next 3 months, you can see that we're going to be pushing close to 70, which is a near record outside of when you go back to 2007 into 2009. That is going, again, to create that inflationary pressure on the back end, which is just going to drive those prices higher. And when we look at just the flash output, so when we look at composite PMI output, you can see that we continue to see that trend higher. The US, Eurozone, UK, remain strong. You can see Japan is essentially flatlined. The Eurozone, it won't come negative again or below 50, but we'll start to see some of this pause, especially as we have France issuing a 4-week lockdown. We have Italy extending. We have Germany already extending. This was just going to kind of cap some of that. But there's also not as much buy-in. So again, that's going to keep some things moving and driving forward, even though we should start to see a little bit of a slowdown. It's just people won't accept it. So there will be a slowdown, just not the levels that we saw, obviously, when this all first started last year. So manufacturing output growth remains strong, especially in the Eurozone, US, UK, Japan in general. We're all seeing that manufacturing output shift up. But again, we're also seeing an increase in CPI, PPI, which is pushing through just importing more inflation depending on where you're going. And as we start to see an increase in COVID cases in some key locations, they're also buyers of products. That buying is going to slow. So we think that there's going to be, again, that global trade is just going to remain a little bit capped as we continue to see some of this pressure with COVID cases that, again, will remain that pressure. And then when we look at fiscal and borrowing outlook, so when we look at just the borrowing side, so what is happening to borrow, just to round it out in general. So central banks, in terms of where things are, the outlook in OECD countries, you can see that the general government deficits continue to remain elevated. They're supposed to come down in 2021. That is all being ratcheted back up. So if anything, it'll still come down. It just won't come down to the same level. But it's also as a percentage of GDP. So GDP is supposed to recover, so the percentages should look better. And then the central government marketable, in terms of net borrowing requirements, again, all of these things that were supposed to come down in 2021 are really coming back up, and that's going to keep the central government marketable capacity on standardized gross borrowing requirements. Those borrowing requirements are going to go up, which is going to just increase those inherent deficits. So then when we look at the gross borrowing through marketable debt as a percentage of GDP, this is what we're talking about with the GDP side. It continues to ratchet higher because even though GDP is going up, it's being driven by government spending, by government debt. So you're getting the GDP bump, but it's coming at a cost, and it's a fairly high cost when you consider, what government investment means versus consumer and underlying, natural investment. So again, these are going to be those overhangs. And just thinking about this from the perspective of this is the Euro area, emerging OECD, OECD G7, they're all shifting up. But we want to look at what is happening at the emerging market level because that's where we see more pain. So according to new IMF research, that low-income countries need to deploy another $200 billion over 5 years. We've already talked about monetary policy tightness, inflation issues. That is limiting that ability to increase. And so but they need $200 billion over 5 years to fight the pandemic and another $250 billion to return to the path of catching up. So $450 billion over 5 years where they can barely feed themselves. This is where we continue to see those headwinds in terms of how quickly do we get back to normal? Where do we continue to see that pressure? Faster progress in ending the health crisis could add $9 trillion to global GDP by 2025. Again, that's why we think there's going to be that lag effect, and we're just not going to see that rally just because COVID continues to ramp up. Obviously vaccinations help that, but we're seeing variants, and there's apparently a new Brazilian variant that is similar to the South African one, and that is going to be some of those risks that exist, especially in emerging markets. Financial risks, including stretched asset valuations, which we've talked about. Emerging and developed countries with relatively weaker bankruptcy procedures would be more heavily affected, obviously, because if you can't protect yourself in bankruptcy, why would you invest there? And then a coordinated green infrastructure push could boost global GDP by 0.7%. The problem is if you look at Nigeria, who is knocking over grain silos and grain storage because they can't feed themselves, giving them $1 billion for solar panels is going to be meaningless if people can't eat. Again, basic needs will be the most important. And then tax systems are going to have to be restructured differently to be more progressive. With IMF financing to sub-Saharan Africa last year was 13 times more than the annual average over the previous decade. That's not going to stop because they're going to have to get funding somewhere, and it's going to be from the IMF, which the U.S. is a big part of that, and the U.S. is already struggling. So again, all of the interlinking problems that continue to come through, even though we keep preaching more stimulus, it's going to come at a cost because we're just going to have to put more paper into the system in order to generate this kind of growth. And that debt is just going to be a huge overhang over the longer term. But now that we talked about that, let's talk about why it's going to be an overhang and how is it working through specifically the U.S. system.